Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And last week, we talked about the motivations for why some traders choose to sell puts for the very short term, maybe get that high time decay, very little time for a trade to go wrong. Well, why in the world would anybody choose to get into a long-term short put contract where we're maybe obligated to might have to buy some shares at a designated price for a long period of time? Well, we're going to be talking about the pros and the cons of that strategy and why for some that's actually their preferred approach. So we're going to be weighing the potential advantages, the potential risks, planning and placing an example trade. But before we can get to any of that, let me first of all say hello to everybody who's already chatting in. I already see all the familiar names chatting in. Thanks for being here, guys. Hello there, Mighty Mouse, I'd Never Eat Here, Kevin, Mark, Eva, Andrew, John, Frank, Tony, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions here. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, well, enjoy the presentation, but be aware that you're invited to join us in the live discussion. If you'd like to be here, this is a Monday webcast series, and we kick things off promptly at 2 Eastern time. Love to have you here in the live audience. And I also want to let our live audience members know that my very good friend Brent Moores is going to be hanging out in the chats with us. Brent's going to be addressing any questions that I can't get to. I've been working with Brent here for more than 20 years. Actually, just hit my 20-year anniversary. Brent, I think you were at like 25 or something crazy like that. Yeah, so thanks for being there, Brent. Brent and I would also like to issue an invitation to everybody listening. If you have an account with X, give us a follow there. You should be following your favorite presenters on X. Pardon me. But that really is the very best place to connect with your favorite presenters in between these live streams. So you can find Brent there on X at Brent Moores CS. You can find me on X at Cameron May CS. But let's get into this discussion of selling puts for the long term, selling long-term equity anticipation securities, puts, otherwise known as LEAPS options contracts. So of course, as we do this, the very first thing that we need to do is consider the risks associated with investing. This is important information, so please bear it in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risk, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right. So let's set the agenda for the day. We're obviously going to be dedicating the bulk of our discussion to selling the understanding of why some traders choose to sell LEAPS put contracts. Now, before we do that, though, I first want to look at our existing positions. So we'll look at those, see if any of those need some management. Then we're going to take a quick peek at the markets, and then we're going to talk about the pros and cons of selling LEAPS contracts for put options. Okay, so there we go. Yep, Eve, exactly right. Yeah, we'll attach a definition to what a LEAPS contract is. We'll plan and place an example trade, all the while talking about why somebody might do this, why somebody might choose not to. But let's go to the thinkorswim desktop trading software platform. And here are our current positions. And what you'll immediately note is last week's trade is missing. That's because we planned it to be concluded before this one ever launched. And it's done. We'll see how it went. But let's see how the other existing positions are going. First of all, we have Apple. This is a covered call trade where we bought some shares of Apple at $235. They're only worth $202. So, oh, we're getting devastated. Well, not so fast. It's not as bad as it might appear on the surface. We have sold this 225 call against that. Wait a minute, Cameron, you bought the stock for 235. You now have an obligation to maybe have to sell the shares for 225. True. But let's look at the full history of this trade. This one actually began as what we call a wheel strategy, where we sell a put. That typically is the first part of a wheel strategy. Now, if you're not familiar with a wheel strategy, let me suggest you do something, because I'm not going to be going deeply into detail on that strategy today. But you can find our previous webcast where we have explored the logic of other strategies, like these strategies, these current trades that I'm going to be going over. We did those in previous webcasts, and those have been posted to our YouTube channel. So if you haven't subscribed to our YouTube channel yet, do that now. Go down to the lower right-hand corner, click on the little subscribe button. It only takes a second. It doesn't cost anything. But then pop over to our YouTube channel. It's called Trader Talks Schwab Coaching Webcasts, and you can find the archives for our previous webcasts right here under playlists. So if I were to click on playlist, for example, for this series, I'd find this series, just scroll all the way down to the bottom. We have a bunch of series, and mine, you're just going to go up 4 rows, and it's right there. Trading covered calls and short puts. If I click on view full playlist, I can then go down through, and I'm going to look for the keyword wheel. Now, I could also just do a search for it, okay? But I wanted to show you this list. And how far back did we do this? It wasn't too far back. Did we go back that far? Let's see, the wheel strategy. It was a little bit further back than I thought. I might have to use my little cheat here. Anyway, I can't believe it. It's not that far back. In any case, oh, there it is right there. I've just let my eyes wander past it a couple of times. Intro to Trading the Options Wheel Strategy for Income. Yeah, about 2 months ago. That's when this trade was initiated. So what that involves is selling a put, seeing if it gets assigned, but collecting that premium. So we collected a $3 premium, but we were ultimately assigned shares of Apple at $235 per share. As new shareholders, we then sold 17th of April 235 calls against that long stock position. So between the put that we originally sold and the calls that we sold subsequently, those realized $3.80 per share of gains. After this, the 17th of April call expired, we sold a 16th of May 230 call, which was closed for a 149 profit. So now we're up in what about the $4.29 range? Is that right? $5.29 range for realized gains on short options. And then finally, we've sold a 225 call for 241. So, yep, the shares are worth less than we paid for them, but those premiums have helped to ease the pain of that somewhat. Had we just bought the shares and watched them drop, we'd be feeling probably substantially worse about the position right now. So Myron says, can you please show that again, the main page title for the wheel strategy? So it was Intro to Trading the Options Wheel Strategy for Income. Now, I didn't have to go through all that. If we know exactly what we're looking for on that homepage, on the Trader Talks homepage, what we might do is just come here and type in, let's say, wheel. Hit enter. There it is. Intro to Trading the Options Wheel Strategy. Okay. All right. But back here to this position, this is where we now stand. Our shares are down here. We've sold a 225 call. It's working its way toward that June 20th expiration. It looks unlikely that that will go back in the money by expiration. Assignment risk is probably pretty low at this moment. It's always present, even when we're way out of the money like this. But in any case, look at that thing. It's only worth 17 cents. We originally sold that for 241. There's not much meat left on the bone for that short option. I think what we're going to do is close this one out. Let's see if we close this out and we sold a call out here for July. How much could we get? Could we stay at that 225 level? Might we need to bring that down to possibly 220? Let's go have a look at the July contracts for Apple. So if I go out here to July, let's say we're able to close out that June contract for somewhere in the vicinity of 18 to 20 cents. And we go out to July, it looks like we could sell, yeah, like the 225. We could still get maybe $1 for the 225 contracts, or we could lower the strike. That means we're agreeing to sell the stock for a lower price. Remember, we bought it for 235. We got to bear that in mind. It's unlikely that we might have to sell for 225, but still, if we're going to get into a contract, might have to sell it for 220 or 225. How about we do this? Let's go ahead and roll this contract, close out the current contract for whatever we can get for it, get into a new one that looks like it's going to net us maybe around $1.50 credit, but realize the gain on that 235 contract at the moment. George, let's see. Make sure, remember on selling cash secured put, you're also getting interest on secured cash. Okay. Yeah, can't go too far into that, George, into those particulars. I want to call and get some direct one-on-one support for those sorts of for that kind of a question. Good observation, though, interesting observation. But let me go here and let's roll this position. Apple, the 225 call. Let's see if we can close it out. Yeah, on the neighborhood of 18, 20 cents. We'll see. It's not a guarantee that just because the current market price is 16 and a half, mean that we're going to get out at exactly that. But let's right click on that call, create a rolling order. Rolling order just means that we're using the same order ticket to close out one position and then get into another one same time. But let's select this. It'll say sell calendar. That's what it bears a resemblance to initially. So we have an order to buy out of this 225, but let's sell maybe the 220, going for the higher premium, but the lower strike. There's potentially a disadvantage. There are pros and cons to doing that. But we're going to go out to the 18th of July expiration. I said it would be maybe around $1.50. Let's say that we're willing to settle for $1.55 net credit on this roll. Let's click confirm and send. Selling, it'll say diagonal now because we have two different strikes at play, but really it's just closing out the one, trying to get into another one. 155 is the minimum credit that we're willing to accept here. We'll see if we can get it. There is a commission to be paid on both sides if the order fills, but let's click send and maybe we'll let that work. What's our market price right now of this trade was 150. Now, look, okay, it looks like we closed out at a 161 credit. All right. So if we go here to our filled orders, we can see the details there. It looks like we closed that short option for 16 cents. We received originally, what was it, let's go back to our charts, 241. So that's now a realized gain of $2.25 on that one, and we'll see how the new one goes. All right, so let's go on to our next position. We also have a position on Abbott Labs, a covered call position. Bought shares for about 100 shares at 128. Those are now worth 134. And we sold the 135 call, and it looks like it's doing just fine. Let's look at this on a chart. So here's what we did originally. Bought the shares at 128.68. Sold initially a 16th of May 135 call. That expired for a 132 profit. And then right here, you'll see where this red line starts. And these lines, I just draw this stuff in to help you kind of follow the history of our trades on these positions. We sold the 20th of June 135 call right here on June 2nd. That's where my red line starts, going out here through the June 20th expiration. Collected 191. It looks like that was still in the how much was it? $1.56 is the current value. So it's doing fine. We're just going to let that one work. General Electric, I think, is somewhat similar here. Oh, no, not somewhat similar. No, not at all similar, but it is a covered call. It's gone deeply in the money. This one is one that in real life, it might have already been assigned. Early assignment is not a thing in paper money. Nobody's out there early assigning fake contracts. But in real life, let's just talk about what we've done. Bought 100 shares of 218 at 218.55, sold that 20th of June 230 call, but the stock has rocketed well above that level. We're at 253. This call is now $23 in the money. The deeper a contract goes in the money and the closer it gets to expiration, the higher that risk of early assignment rises. Although, we have to sort of define risk. It can change from one trader's perspective to another. Risk here means, we might have to sell the shares for 230, those same shares that we bought for 218 and a half. So that would be a realized gain on the shares. Plus we'd keep the premium. That would be a realized gain on the premium. And we'd be cashing out here for like about a $15 gain. So is that a risk? Yeah, it's not maybe quite as much had we just owned the shares, not as much had we just kept the shares, but it's just a forced profitable exit. For this one, there is no risk of early assignment. What I think is interesting here, we're going to leave this trade on. It would be interesting to me to see if we could get this thing to collapse so we could talk about how that's a possible outcome before expiration. When we think we know exactly what's going to happen, the unexpected can occur. But I'm just going to let this one work. Now, John says, in the wheel strategy, aren't you just in the business of selling both puts and calls? Now, John, that's kind of, we're limiting it to just selling calls and puts. No, there's also stock ownership involved here. So we have to remember that element. Mark says, with this GE position so deeply in the money, do you have a preference whether to exit the option, sell the stock early, or just sit back and let it get assigned? Another good question, Mark. If we were to exit this option right now, it would cost us about $22 more, $21.50 more, very likely, than what we sold it for. We would have a realized loss on the option. However, it would then allow us to keep these shares that are worth so much more than we paid for them. All right, that's cool. As long as the shares remain valuable. If those shares then subsequently collapse, well, then we're sitting on a loss on the option and we're surrendering profits on the shares. And that can be sort of a 2-for-1 whammy. So, yep, that's always left to the discretion of the trader, but we just have to be aware there are pros and cons to each decision we make like that. In this case, kind of have the luxury of knowing that I'm not going to get assigned with this paper trade. But I am curious to see what the stock will do, and I'd like to have this position to talk about it again next week. So I'm going to just leave it. Okay. All right. But we do also have Tesla. Our Tesla position, another covered call. We haven't only or exclusively done covered calls. This is called covered calls and short puts. We did a short put last week. Where is it? We'll talk about that. But our Tesla position, bought the shares for $233. They're worth $300. Sold a 365 call for $970. It's only worth $1 right now. Let's look at what's going on with Tesla. This is pretty dramatic. So here's where we bought those shares. We thought they might be getting set to move, and they have. They've been running up and up and up. Along the way, we sold a 17th of April 280 call. That one expired. We let the shares run up further, and then we sold a 365 call. Right here, if it's helpful, it was this day when we sold the 365 calls, and the stock went right up to about 365 and then turned and started coming down again. So for the call position, that's great. It's not so good for the underlying stock position. I mean, it's still doing fine. It's way above what we paid for those shares. But maybe if we could close this out for maybe 10% of what we originally received for that call, sold for $970, looks like we could close out for close to $1. We'd be retaining most of the value there. I wonder what we might have to roll this down. What if we were to sell, let's say, or roll to something like this? Let's go down here to 325. So that'd be increasing the risk of assignment. If we were assigned here, we'd be selling the shares for 325 that we paid 233. That'd be what, that $87 profit on the shares. But what could we get for these July contracts? Can we get more than $1? Let's look at July, 325, $15. Okay. Is there an earnings announcement or something in between? Nope. There might be. Let's see. It's probably going to fall right after this expiration. How about we do that? Let's close this one out. If we wanted to, we can maybe even push this up further to 330. Let's look at the chain again. 330, we could still get somewhere $13.50. You know, if we just wanted another around $10 like we did on the last one, that would be around 345. Let's go here. Right click, activate the drawing. Maybe we push this up here to 345. Mark says, check out the implied volatility. Let's do that, Mark, because I want to talk about that today in today's discussion anyway. So if we want to look at the implied volatility for this stock, we can go to, if you didn't see what I did, go to our our edit studies icon at the top, implied volatility is among the available studies. Let's type in IMP for implied volatility, add that to our chart, click apply and click OK. And it looks like it's actually, Mark, I was about to say mid-range, but really we had this pretty exaggerated implied volatility peaks here and here. Could we go back up there again? Yeah, but are those, let's say, normal? Not as normal as maybe something like hitting peaks around here. So this is kind of high-ish implied volatility. Could explain why we're getting such large premiums. So in any case, let's go to the 345. Let's do that. The 18th of July, 345. Let's go to our monitor tab, right-click on the existing position, creating a rolling order, and this is going to create an order to buy back the 365 for the 20th of June. And let's go for a 345, 18th of July. So we're now agreeing to sell the shares for $20 less than we had previously agreed to sell them for, but we're also bringing in about $9 more premium. So there's a trade-off there. Looks like we might be able to get in about $9. Let's say we're willing to settle for $8.75. How about that? Let's set that at, I'm going to use that, dial that up to $8.75 as our preferred credit. But let's click on confirm and send. This is to sell. It's described as a diagonal, but basically to close out of the short, get into another short at a more distant date. Trying to get $8.75 net credit out of that. There's commissions to be paid on either side, 65 cents out, 65 cents get back in. Let's send that order off and immediately done with an 888 credit. Cool. All right. So what does that mean for our closed position? Closed for 107, originally entered that position. Remember here, entered for 970. So that's an 863 profit on that June contract. All right. Now, John asked about, can you cover the choice for analyze the rolling trade? So I could throw that up on the analyze tab. That would just take a little bit too much time to cover, John. We only have 23 minutes left in the webcast. I might have to park that, discuss that at a future date. But let's get on. We've now managed existing positions, rolled 2 of them. We have last week's trade. Last week's trade was our Microsoft position. What happened to it? Well, here's Microsoft. If we want to revisit the logic of that, for now, let's hide our implied volatility. We don't need that anymore. Well, this was last week, June 2nd. What we noticed with Microsoft that some technicians might have noticed is that we'd recently broken through a price ceiling that hadn't been accomplished in about 11 months. And that may have been signaling that the price was set to go on a nice upward run, which is bullish. So we sold a put, which is bullish. But in this case, what we did is we sold a very short-term put. Look at the length of this little line that I drew. I'm going to zoom in here just so you can see it a little bit better. This was the complete duration of last week's trade. We sold it on the 2nd, and it was set to expire on the 6th, which it did. Sold the 450 put, which gave someone the right to sell shares to us for 450. But the shares were worth more than that. And on the 6th, they were worth $30 more than that. We weren't assigned. Contracts expired worthless for a 78-cent profit. So if you want to revisit last week's discussion, selling these short-term puts for income, you may want to go check out the archives on our YouTube channel. But this is going to take us to our anyway, let me also just summarize by saying that's what happened to our Microsoft trade. It actually ended profitably. It's done. Nothing we need to do with it here. But this leads to our discussion for today. Well, what about those traders who don't sell very short-term options? Maybe they sell long-term options. To me, it's almost like it's more intuitive to sell short-term options. Good. I'm in an obligation for a very short period of time on a day-by-day basis. There's a high degree of time decay depending on the strike that's selected and the stock that's selected. But those motivations are fairly straightforward. What are some of the trade-offs, though? Well, with this short-term put, this thing went up $20 or $30, and we'll call it 20 from the close of that day. Anyway, or from about the time that we were discussing the trade. But in any case, for that $20 move, we made 78 cents. So I made the right call, the right decision, but we made a very small profit. Well, that's, for some traders, that's totally fine if they're getting high probability profits on a regular basis. You know, if they can be right on a relatively consistent basis, that's a big if, but that might be the motivation for doing this sort of an approach. For other traders, though, they might say, we left money on the table here. We could have used this same strategy in an entirely different way, and it benefits from strong moves upward. And that is selling longer-term options. Now, Princess Investing says, what system are you using? Is this the Thinkorswim platform? Yes, it's specifically the Thinkorswim desktop platform that can be downloaded free of charge from the trade tab in your Schwab online account. Then you just use your Schwab username and password to log in. But I want to talk about selling these longer-term LEAPS contracts, long-term equity anticipation security. So let's set up a trade example. Actually, I don't need to go there. Let's go back here. And I'm going to be using Gilead Sciences for today's discussion. And it's going to tie to, who was the one that said, check out the implied volatility on our trade? It was, I like to give credit, Mark. Yeah, giving credit where credit is due. Implied volatility could very well play an important role in this approach to selling puts. But here's Gilead Sciences. And maybe our trader has looked at the S&P 500 and they've noted, boy, the S&P is really on a tear, running higher and higher and higher, and selling those short-term puts. Okay, maybe we're collecting a little bit of premium, but while we're waiting for a few days for those contracts to expire, stocks are really running up. And those short-term puts maybe aren't offering a very big, even if they're adding up to some decent profits, maybe there's some money being left on the table here. Is there a different approach that we could take to this bullish strategy? And so let's just say that our trader is still bullish on the S&P and other related indices. And so they intend to employ something like selling puts as an income strategy, but they want to take this other approach. So going back to Gilead, here's Gilead, and you'll notice it took a bit of a dive when most of the markets did, and it's been in recovery mode as most of the markets have been. So let's sell a put on this one, but we're going to sell not a short-term option, but a very long-term option. So for those of you who are not familiar with the acronym LEAPS, L-E-A-P-S, I'll just tell you, all it means is that we're talking about long-term options. Specifically, the acronym means long-term equity anticipation securities, LEAPS. That's a big fancy name for a long-term option contract. Specifically, actually, if you Google it, you'll find there are differences of opinion. Some people will say at least 9 months. Generally, it's accepted. It's a long-term equity anticipation security, a LEAPS contract is a year or longer. Let me just say, who cares? I don't even know why these things need their own name. Brent, maybe you can educate me here. Is there anything special other than being more than a year about LEAPS contracts? Not in any way that I've discovered yet. So I don't care if you just want to call a long-term contract, if you want to sound fancy, call a LEAPS contract. And by the way, the acronym is LEAPS, so the singular and the plural is LEAPS, as awkward as that feels. We wouldn't say a LEAP contract, because that's leaving the security out of long-term equity anticipation security. That's me nitpicking. Yeah, there you go. Brent says, can't think of anything special about LEAPS, just long-term options in my mind. Me too, Brent. So we're going to go longer term with this. So let's build one. Let's go to our option chain. Let's open up our scratch pad so we can outline our example trade for the day. I'm just going to call it a short LEAPS put. Long-term put. So that's going to put us out past June, July, August, September, October, November. We're going to look at the number of days in parentheses. And look at that. There's the 18th of June, 374 days from expiration. These contracts don't expire for a year. So this is what I'm going to do. I'm going to go to those 18th of June, and I'm going to see what we can sell a put contract for. And how about we do this? Okay, let's talk about pros and cons. This is going to be most of what we're going to spend our time on as we discuss LEAP's contracts. There are pros to this approach. There are cons. Should we start with the fun stuff? What do you notice immediately if we look at the 18th of June versus like let's say if we went all the way back up here and looked at these 4-day contracts? Well, if I sold and at the money, how about we go with the 115? I don't think there is one. LEAP's contracts. Yeah. The 115. Notice there's not a 114, a 113, a 112. These go in $5 increments versus the $1 increments for the short-term ones. But if I look at this at the money contract, 14-ish bucks versus this 4-day contract, $3. So yeah, Mark, Greg, Sia are saying you get bigger premiums. That is a primary motivation for traders to go for these long-term options. You can get these big old premiums. Now, a secondary advantage to that is that we don't need to go at the money or even close to it to still get these. Shall we use the word juicy? To me, that sounds like I'm emphasizing the attractiveness of the strategy too much, because there are definitely cons to this as well. But yeah, they're bigger premiums, no doubt. Look at how far out of the money we can go. Let's say our trader is just looking to get, I don't know, a few percent here. They could go all the way down to maybe even the 80, the 85 contracts. How about we look at the 80 for our example today? What if we were to sell the 18th of June, $80 puts, trading for between $294 and $335. If we split the difference, let's say we can get $3.15 for those. Isn't that about exactly what we were getting for the at the money put for the 4-day contracts? Yeah. We've gone way out of the money. Let me help you visualize this. This is a secondary benefit. These great big premiums mean that the trader can go way out of the money and still get quote unquote juicy premiums. If I go to the chart here, where is $80 on our chart? If I draw that in down here, this is where it is. This is the contract we're considering selling. Let me right click on this. I'm going to edit the properties a little bit. Let's make it nice and flat at $80. Start and finish. And let's punch that maybe even all the way out to next year. Basically way out there. That's the put that we're considering selling. It is way out of the money. That brings us, so we have big premiums. We can go further out of the money. What's the early assignment risk right now on this contract? It's probably not very strong. Someone has the right to sell us shares for $80, but those shares are worth $113. They could decide to, on a whim, I guess, sell us shares for $23 less than they're worth. That would be twist my arm if you have to, make me buy shares for $23 less than they're worth. Assignment risk is much lower on these contracts. So Tech FC says you have to be so bullish. It is definitely a bullish strategy, right? And not only that, it's a long-term bullish strategy. So higher premiums, you can go further out of the money. It's unlikely for early assignment. And also, even this $80, if the stock were to fall, that's not even our break-even point. Where's the break-even on this? Well, if we put the shares at $80, but we already collected $3 for that, our break-even is $3.15 below that. So our break-even is going to be down here at $76.85, right around there. close enough. So I'm just going to draw that in. That's the break even. So there is a strong tolerance for downside. However, we're giving this thing a long time to go wrong. So let's talk about some of the cons of this strategy. One of the cons, it's true of short-term and longer-term contracts, is there's a big downside risk. If a stock happens to collapse in value, it could go theoretically all the way to zero while we're in a contract where we have to pay a fixed price for this. In this case, it's a fixed price of $80. It's just that with a short-term contract, there's only a few days for the trade to go wrong. With this one, there's a year-ish for it to go wrong. So Tech FC says, shouldn't we look at the 3-year chart? We could. Yeah, let's do this. Let me right-click on this one. I'll just edit its properties. Let's put that right at 76.85. Let's extend that out a year. And then if we switch this up to a 3-year chart to kind of see, actually, let's change this to a 3-year daily chart if you like to see all the days. That can give us some views of where major support areas are. And I think somebody already called out, it looks like there's a possible area of support around 90. Yeah, on a 12-month chart, pretty good support, possibly an even stronger one here. But I'll switch it back to the 1-year chart. Yeah, there's large risk for the short term and for the longer term. It's just that theoretically now, it's easier for more of that large risk to be realized in the long term. Also, both of those approaches tie up a fair amount of cash. In a margin account, it might be on the order of 20%. In a cash account, if we have to buy the shares for $80 and we only collected $3, we might have to come up with, it might tie up $7,700, and it might tie it up for a while until we decide to get out of the trade, or I guess until we're assigned. Another disadvantage to this strategy is that these contracts can be illiquid. Not a lot of traders are trading that far out in time, so there can be an even greater priority placed on just sticking with the most liquid stocks out there to try to get those spreads between the bid and the ask price as close as possible. The one that we're talking about 40 cents on a $3 contract is about 13% spread between that bid and that ask price. And in the world of Leaps contracts, that's not all that wide. All right. There's one other thing that we need to talk about, and that is, let's get right to the real driver of a traditional short-term put, selling a short-term put, and that is time decay. If we sell the short-term put on this one, let's say we sold, just one of these short-term ones. Oh, let's stick with the 115. Look at that theta. 24 cents of time decay on a $3 contract. That's pretty close to 10% per day. It's not quite 10% in this example, but pretty close. If we compare that to our long-term contract, what percentage of time decay are we collecting here if the trade is going for us? We're getting, somewhere around, well, let's go back to our 80. $3 contract here. Are we still getting that 24 cents? Nope. A penny. And even that penny might be rounded to be a little bit more attractive than it seems to be. In this case, let me ask you, those of you who sell these long-term options, just paper, real money, I don't care. Is this the real driver of the trade, or is it maybe something else? Very likely, it's going to be Delta and possibly even our Vega. Notice on this $113 stock, if this stock goes up $1, and by the way, what's it been doing? It's up half $1 today. It's come up, about $8 just in the last week or so? That can really shift the value. That can accelerate the earnings potential of this strategy. That's really what our traders probably looking for in the early stages of this trade. They're not it's nice that time is probably working in the favor of this trade. But what this really leverages is if the stock continues to go in the correct direction, that delta is contributing to that bottom line faster and faster in the form of unrealized gains. Now, obviously, delta can work in the opposite direction. If the stock starts to drop, that delta can work against us. So, yeah, price is quite possibly the real driver of this trade, but also our Vega. Volatility changes. A 1% change here, 1% increase could increase the value of this option by 23 cents. Ouch. We don't want this to increase. That would be a ding to this position of about 6 or 7%. Instead, what we'd like to see is volatility to decrease. So let's talk about the priorities of our trader here who's doing this strategy. Number one, they may choose to push out of the money as far as they can. So if the stock starts to wiggle around, if that delta hits them, they might still be able to wait and see if it recovers. They may also emphasize selling high implied volatility. Let me bring up our implied volatility chart again. And unlike our other one, which was kind of had a couple of peaks, so we're pretty prominently above it, look at where Gilead Sciences implied volatility is right now. What this means could mean a couple of things. It could mean that the premiums are even higher than they might normally be. It also means if implied volatility were to come down, we then have that Vega, what was it, 23 cents? Yeah, 23 cents working in the favor of this trade. If it goes higher, we don't want that. We want that volatility dropping. So really a combination of the stock continuing to climb and volatility levels dropping. This might allow the trader to get out of this trade with a profit even well before time can contribute substantially to that. So here's what I'm going to do, and this is what some traders will commonly do with an approach like this. They're not really waiting for the passage of time. Instead, their plan might be just to take profits if they can. And in this case, let's say we collect 315. Let's see, what is it still offering 315? Yeah, it's right around there. I'm going to put in an order to sell one of these contracts. But with the plan, let's dial this up to, now could we get 315? Let's just try for $3. But I'm going to put in a subsequent order. Let's change this from a single order to a first trigger sequential to close this out. If we can get out at any time, maybe this next month, maybe a couple of months from now, possibly never. But let's see if we can get out for $1.50. How quickly, if volatility is dropping and the stock price is going up, the combination there might be 50 cents. That could happen relatively quickly. Surprisingly, maybe even much faster than waiting around for a year or even half a year to see this work. So let me just click confirm and send here. Let's sell these puts, trying to get at least $3. We're going to close those out. If we can close out for $1.50, there are commissions in and out that we need to bear in mind. But let's send this order off. I think let's see if we can get a fill. Liquidity can be an issue with these LEAPS contracts. That's why the trader might really stick with the most liquid stocks. There we go, guys. We've actually talked through. Vic says, how did you locate that option with high theta? I literally just, Vic brought up the implied volatility chart, just clicked through a few until I saw one that was high. But in any event, guys, we have accomplished what we set out to do today. I just wanted to talk through the pros and the cons, the logic of maybe selling long-term equity anticipation securities, but it's quite different than the short term. In the short term, time decay might be the emphasis. In the long term, it might be which way is the stock going and what's happening with volatility levels. So we'll see how this one goes. We're going to revisit this in the coming weeks. Time for me to let you go enjoy the rest of your day, though. But as you do, just remember to subscribe to the Trader Talks channel if you haven't done that yet. You can just go down the lower left-hand corner, lower right-hand corner, and click on that subscribe button. That only takes a second, doesn't cost anything. Also, make sure that you're following Brent and me on X. You can find Brent on X at Brent Moore CS. You can find me on X at Cameron May CS. There's my handle. You can even see this kind of random thought I had last night. I just realized I was born much closer to the last Model T than to the first Cybertruck, and I'm only 52 years old. Ouch. Hey, everybody. Thanks for all the thumbs up. I see 150 people watching live right now. 37 have already clicked that like button. That helps. It gives us a boost in the YouTube algorithm, helps more people find these webcasts. Also, it's a nice pat on the back to the presenter. I didn't see a survey come in. Nope. So we're good there. But everybody, thanks for giving me your time today. We will follow up on this trade in a future webcast, and follow up on our other trades. But I'll look for you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, so I want to wish you the very best of luck. Happy trading. Bye-bye.